In this video, I'm going to talk about prepaid expenses. What are prepaid expenses? These are expenses paid in advance. Some common examples that you might see are prepaid rent, prepaid insurance, and office supplies fits in this category as well. Now, this is an accrual-based accounting topic. If you are using cash basis accounting, then instead of going through this process, you would be more likely to simply record these things as expenses when paid. But if you're using accrual-based accounting, then you will want to at least be aware of this process. And keep in mind that you would be more likely to do this process if you're paying for several months of rent or insurance in advance. But if you're just paying it at the beginning of the month or monthly, then you would probably just record it as an expense. And I want to point out that prepaid expenses are asset accounts. If you think about what an asset is or the accounting definition, assets are economic resources, things the business will use to help run their business, things that will benefit the business in the future. So prepaid expenses are assets because if you pay for several months of insurance coverage, that will benefit your business in the future as you have that insurance coverage. And what you're going to want to do is adjust periodically for any amounts that you've used up or any amounts that have expired. And when I say adjust for what's used up, all you're doing is transferring from the asset account to the expense account. So for example, if you paid for 6 months of prepaid rent in advance, you would put that in a prepaid expenses or prepaid rent account, and it would be an asset account. As time goes on, you're going to use that rental space, and the amounts you use, you want to transfer over to rent expense, because expenses are going to be things that you use up, expenses you pay to operate your business. So as you use the rental space, that is more of an expense. So you want to divide up the amounts based on what's actually happening. And I'm going to walk through some examples to just make this very clear. So for example, let's say a company pays rent of $12,000 for 12 months. That breaks down to $1,000 a month. Under this process, if you're using accrual-based accounting, you would put it in a prepaid rent asset account. And then of course it would probably be deducted from your checking account or cash. You wouldn't do anything to rent expense yet because you want to wait until you actually use the rental space on a month-to-month basis, and then you would transfer what's over here in prepaid rent, which is on your balance sheet, over to rent expense, which is on your profit and loss or income statement. Okay, so let's look at what would happen each month. You would do a monthly adjustment to transfer 1 month of insurance over to rent expense. You wouldn't do anything to the checking account. You've already accounted for the money that came out of your checking account. So checking account is going to stay as is other than your other checking account transactions. But as far as prepaid rent and rent expense, you would take $1,000 out of prepaid rent and put it into rent expense. So you would have a credit over here under prepaid rent and a debit under rent expense. And hopefully you already know debits and credits in T accounts at this point, but this is how it would look in the T accounts. And then you would get a balance after that adjustment. Prepaid rent has gone down to $11,000 to represent you still have 11 months of prepaid rent. And then rent expense on your profit and loss is now going to show $1,000 that you've used up 1 month of rent. And that was an expense. And you would just keep doing the same adjustment of $1,000 every month until you've finished using up that rental space for the year. So over time, you would have multiple credits to prepaid rent and debits to rent expense. And then by the time you get to the end of 12 months, you have zeroed out prepaid rent. Your checking account didn't change, other than there would obviously be other checking account transactions over that time period. And now your rent expense account would have shown $12,000 total. And then if you wanted to look at how this would look in a journal entry format, these would be the journal entries you might see. You're debiting prepaid rent, crediting checking for the initial payment, and then each month you would be debiting rent expense to add to the expense account, and the credit to prepaid rent would be subtracting or offsetting this debit. So now what I want to do is walk through another example, but this time we're going to do it in QuickBooks, and I'm going to show you how to set up recurring journal entries so that you can set this up when you pay the expense in the beginning and then not think about it the rest of the year. So here I am in the QuickBooks sample company, and there's already a prepaid expenses account set up. Now you could have separate accounts. You could have a prepaid insurance account, a prepaid rent account, but I'm just going to use what's here. I'm going to do an insurance example, and there's already an insurance expense account set up as well. So I'm just going to use that also. So let's walk through an example. Let me go to a vendor. There's already an insurance agency vendor set up, so I'm just going to use this and create an expense. Let's say they pay $10,000 for 12 months of insurance coverage, and I'm purposely using a number that's not going to be an even number. So you would put this in your prepaid expenses account, and it would be $10,000 as the amount. So I'm going to save that. And if I were to run a balance sheet right now, which I can do that real quick, it's going to show up in the assets section of this balance sheet. And here it is right here. And it would not be on the profit and loss. Well, it's now in prepaid expenses right here. Now over time, that insurance coverage is going to expire. So what I would want to do is set up a monthly adjustment to transfer this amount over to insurance expense. So the first thing I would do is calculate what $10,000 divided by 12 months is going to equal per month. So if I just put in this calculator, 10,000 divided by 12 months, that comes out to $833.33 a month. So I'm going to need to figure out how to break it down per month, but I'm going to need to zero this out exactly $10,000. So if I were to do an adjustment of $833.33 per month for 12 months, that's not going to equal the full $10,000. It's going to be 4 cents short. So what I usually do is change the first month's amount, and then the rest of the 12 months can be an even number or the same number, just because I like to set up recurring transactions. It makes it easier. So I just created a little spreadsheet to make this easier to show you. So you could do it a couple ways. You could do it in even dollar amounts if that's just easier for you and you prefer that. It makes it a little cleaner on your profit and loss. Or you could break it down with decimal places, which is probably more of what I would do personally. But either one of these is probably going to be fine. It's not going to make a huge difference either way. But basically what I'm saying is to get to the $10,000 yearly cost, I have $833.33 per month, but in the first month I added that extra 4 cents so that it evens out to the total of $10,000. Or I could have used even dollar amounts if I want it to look nicer, neater, cleaner by having even numbers. Either way is probably not going to make a huge difference. The numbers are very similar. So I'm going to use this setup right here. I'm going to use these numbers. And what I'm going to do is go ahead and make a journal entry for that first month of $833.33 $837. So I would just add a journal entry for 1 month later. I'm going to debit insurance expense, and I'm going to credit prepaid insurance or prepaid expenses. And I'm going to go ahead and save and close. And you can see that that is going to bring the balance of prepaid expenses down to $9,166 after 1 month has expired and is no longer prepaid. And I'm going to want this same adjustment another month later. So I'm going to go ahead and enter this second month's adjustment another month later, which would be March 11th. And it's going to be the exact same entry, except now it's the 833.33, so I can follow along with that calculation that I showed you a few minutes ago. So I'm going to save and close and show you how this is going to look now. So now after 2 months are over, that's going to bring the balance down to $8,333. I'm going to go back into this entry. And what I'm going to do now is make this a recurring entry to post every single month. So I would click on Make Recurring. Zero days in advance. And this is going to happen on the 11th day of every month. And I've already done the February entry. I've already done the March entry, so I'm going to go ahead and click on starting this on April 11th. And then what I'm going to do is also mark when this needs to end. I've already created journal entries for 2 months, and I just need to end this after 10 occurrences. And that's it. You would just save the template. And then to get to those recurring transactions, you would click on the gear icon, and here are the recurring transactions, and you can see the prepaid insurance recurring entry right here. Now I just want to point out that I did my first adjustment here a month after the insurance policy was paid, but some companies like to put their insurance adjustment or prepaid expense adjustment at the end of the first month. If you're paying it on the 11th, then at least 3 weeks has already gone by the end of the month. So I do see sometimes people going ahead and moving this up to the end of each month, especially if it's closer to a full month already, like if you paid the insurance on the 3rd or the 4th. By the time you get to January 31st, it's already been almost a month, and maybe you want to see that insurance expense on that January financial statement. So it can get a little intricate, it can get a little complicated. I just defaulted to what a textbook would probably show me to do. That's all. I would say if you're not sure or you're unclear, then ask your tax preparer what would be best for your specific company and your specific situation. I hope this video was helpful. If you have any questions, feel free to comment below, and thank you for watching.